back to back. And yeah, I do think we were able to make quite a smooth transition between the episodes because we just had a roundtable with Danny and with Vlad from Tau Labs. And at the later part, we were talking about the rise of OpenCloud and the X402 payment standards. And of course, that leads inevitably to the discussion of how to fuel that entire industry. So, yeah, now that is where you are coming into play with Silicon.net. So, given that you have quite an extensive DeFi background, we've crossed ways. I think the first time it was almost 3 years ago, back in the Aperture days. Maybe you can shed a little bit of light what got you into the industry in the first place and how you ended up building Silicon.
Yeah, those were very different times back in the Aperture days. Yeah, so Aperture, for those who aren't familiar, this is like my first full-time foray into DeFi. I had been working in Web 2 and kind of got crypto pilled in 2020, like early 2021, and then left and joined Aperture as the head of growth, like the end of 2021. And Aperture really, Aperture, that project had many lives, but really what we were starting off doing and what's relevant for my role now at Silicon is Aperture really was like selling yield, like packaging yield into smart contracts. And the first instance of this we had, and Max, I'm not sure if this is the product you were talking about, but we were big on Terra Classic. We had famously productized this delta neutral strategy that like Steven from DeFi Dojo and a lot of these other like OG KOLs from the last cycle were really hyped on. And this is basically like the greedy version of Anchor Earn, where if you liked the 19% Ponzi yield of Anchor Earn, you were going to love the 40% Ponzi on Ponzi yield of this delta neutral strategy on top of Anchor and Mirror. And so that was like my first foray into crypto. And the thing about that that's interesting and relevant now for what I'm doing at Silicon is that was like my first instance of seeing how quickly fires can light in crypto when you have product market fit, and how seamless onboarding and how seamless capital flows can be. And so like, back then for that product, we went from 0 to 120 million of TVL in a span of like 4 or 5 weeks. Because we had this yield product that everyone knew about and wanted. And like we had automated it. And so boom, all this money came rushing into the doors. And when I was chatting with Paul, the CEO of Silicon, like 6 months ago, about coming on as their growth lead, this was the kind of thing for me that was really ringing a bell. And so just like quick spiel on Silicon for those who aren't familiar, we are a platform that tokenizes NVIDIA servers. We tokenize GPUs. And these aren't just any GPUs. These are the kinds that are like living in professionally managed data centers and that are used by AI companies who want to pay on an hourly or weekly or monthly basis to do like large scale training runs or to run like high loads of inference. And so what you get with Silicon is you get exposure to this underlying server asset itself, but more importantly, you get access to these cash flows that come in on a monthly basis from these companies that are renting out these servers. And all of that flows on chain. And we've wrapped it into this like pool token setup. So you can get, you can buy as little as $1 of exposure to this pool of servers that cover different server types and are being used by different clients. And so really what we're selling is we are also selling this yield product. And what we've actually seen is that like in the current market, the yield is actually around, like we've been getting around 19%, which is funnily enough the Anchor Earn yield rate from the 2021-2022 cycle. So we've come full circle. Fortunately, this is a lot more reality driven than what the UST yield was back in the day. And yeah, so that's what got me excited about this project and the kind of why I wanted to come on board. It was like, oh, AI is obviously here to stay, and I'm very bullish on AI CapEx continuing this like parabolic trend it's been on over the past few years. And I'm really bullish on this opportunity that there's this certain part of the certain like niche in the market to use these, like, basically, what we have is we're basically taking these, like, it's not the latest generation of NVIDIA servers. We're not really working with Blackwell servers. Those are all bought up by hyperscalers like xAI, Anthropic, OpenAI, etc. And they're used for these like large scale training runs. What we're really like, our sweet spot is these like smaller companies that are doing a lot of inference or they're training a much smaller model and they want to rent by the hour and they're okay using these like older models like H100s. And these are still expensive servers. Like to buy a used one is still like $170,000. But the economics on these are quite good. And I think the economics are actually even better than what these companies that exclusively like rent out to hyperscalers like CoreWeave are seeing, where their returns are much closer to like the risk-free rate. Of course, there's tons and tons of scale in that hyperscaler space, and but in this niche that we're in, there's still like tens of millions, if not hundreds of millions of dollars worth of servers that can be deployed that could get somewhere between like a 10 to 29% return annually based on the current market. Anyways,
Well,
that was a lot, Max. I'll pause there. I might have gotten a
yeah,
little ahead of
so
myself.
when you got started, what was the limitation or what was the previous bottleneck in the GPU market that both created the demand to access the capital from like DeFi native deployers, and also what made DeFi so suitable to deploy? Out of all things, you could have tokenized GPUs as a product.
Yeah, great question. So, I guess like if you zoom out a little bit and like to talk about the market we're in, there's sort of like three major participants. There are the companies, individuals, institutions who need compute and they're willing to pay for compute. That's like the demand side. Then there's the like marketplace, the neo cloud, the platform that brokers the relationship between that demand side and then the actual owners of the servers, and then of course they're the owners of the servers themselves. And the reality is that in this marketplace, the owners, which is really what we're tokenizing that ownership of the server. There's not necessarily like DeFi isn't needed in the sense that like, oh, there wouldn't be enough servers to like supply the compute demand if DeFi didn't, the internet capital markets didn't step in to backstop. It's not like that. There are tons of family offices and other like very wealthy individuals that are going out and buying like multi-million-dollar fleets of servers to like run, similar to how you might run like any other kind of cash flow business, like you're buying an office building or a bunch of Airbnbs. I think what we're trying to do is really like democratize access to this financial opportunity, and that's the real the value add is for the DeFi user. This is an asset class that was pretty much off limits to the average person who wants to punt something under like 6 figures. This is really like an investment opportunity that like you had to be investing hundreds of thousands, if not like millions of dollars to get exposure to. And so I think what we're really trying to unlock by using DeFi is to like bring this to the masses. And in doing so, we'll be able to create a platform and a brand that can later go on to tokenize other like deep tech emerging investment opportunities that'll pop up down the road. Like we might be able to tokenize energy rights or like robotics, or there's all these other kind of like, future tech ideas you can imagine that could be put on chain alongside other traditional RWAs that have not come on chain yet. And that's kind of the democratization is the main, I think, unlock for us. And then of course, like composability in DeFi makes these things a bit more interesting as well.
So when talking decentralized compute, tokenized compute, and like investing into data centers and like all of these infra layers across the, let's put it in a very general way, AI stack, there have been some projects around over the past couple of months, some even a few years also. The big ones I can think of is USD AI, Gaib, there's also Akash. So where in that entire stack do you guys fit with silicon.net? Are you directly competing with these other ones, or is it more of a synergetic relationship? And in the differentiation, maybe you can go a little deeper into how you differentiate on the economics and mechanism side, but also to the extent you appeal to different capital and investor bases.
Yeah, yeah, this is a good question. It's one that we get a lot. I'll start by saying I confess I don't really understand what Gaib actually does. I've read their docs a lot. I followed their TGE. It all like kind of smelled a little funny to me, and their docs never fully made sense that they were like lending capital to GPU owners, that they were buying GPU servers. Like none of it made sense to me. So I can't speak for Gaib. But Akash and USDA I have a pretty good understanding of, and I guess so to go back to my original framing of like there's the demand side, people who need compute. There's the cloud marketplace that brokers the relationship for the demand side to the owners of the servers. If you start with Akash is like basically trying to be this cloud marketplace. So our servers, for example, they're run on a platform called RunPod Secure Cloud. And this is they're a private company that popped up in the past few years to service this AI boom. I think they announced recently they're doing about $120 million a year of like top line compute demand. Akash is a similar platform. They're this like very like on-chain native version of like a marketplace that tries to broker the demand side and the owner side, the server side of the compute world. But for perspective, Akash, like to date, since they launched like 3 years ago, I think they've only done like $5 million of like total compute demand. And so they're like one of these, they're a marketplace partner, but I don't think they've like really had traction. I think they've kind of struggled to scale on the demand side of getting like serious companies and teams who need compute to like want to like deploy lots of demand on their network. I haven't done a lot of research into like how big their fleet of servers are. It looks like it's pretty big, but anyways, yeah. So that's Akash. They've been around for a lot longer. I think they're an instance of a project where like blockchain isn't helpful. The people who like the demand side, which is what drives this marketplace, like they're not really interested in messing with this like crypto on chain thing. Like any of the benefits of that are like not helpful for them. What they want is just like big clusters that are ready instantly and have really, really good uptime. And that's where these like traditional cloud marketplaces like RunPod, or if you go all the way up the stack to AWS, this is where like those shine. Um, and then so USD AI, this one's quite interesting. They're actually neither of the three categories. Nothing to do with demand side, nothing to do with the cloud marketplace, and nothing to do with the like direct ownership of the servers, but they're really just like a financier, the bank that lends to the server owners. So USDAI is this big private credit platform that's really blown up in 2025. They're in the process of TGing right now. I could talk about that. There's been some controversy around their like points campaign in the ICO that I've been following pretty closely. But yeah, USDI is basically like you are an owner of servers, and you want to buy more servers. You can go and collateralize. If you have $10 million worth of H200s, you can go and like post these as collateral with USDAI, and you can borrow against them to buy more servers. And so if you're a DeFi user and you have money in USDAI, you're really getting exposure to like a lending market like yield. I like to think of them as a sort of like Maple Finance, but for data centers or neoclouds that need to finance a purchase of more GPU servers. And so to tie it up, Silicon, we are like basically direct ownership of that infrastructure itself and direct ownership of any of the cash flow and the business opportunity that exists there.
Maybe can you walk us through the platform through a screen share? I know you guys have a pre-deposit campaign going on, so maybe we can use that as an opportunity to go in detail through the mechanism, the kind of beginning to end payment flow, where the dollar comes from, how it gets deployed, and then ultimately how where the yield is coming from and how it gets paid out.
Yeah. So I'll start by saying before I screen share, like a little bit of history. So historically, Silicon, we tokenized individual servers as NFTs. And we did a couple of these NFT drops last year in 2025. I think we sold like about $1 million worth of like these consumer cards that cost like at the time around like $5,000 a piece, these like 50, 90, 40, 90 cards. And so that project was like pretty simple. Like you bought one of these servers, it was in this data center, it was on RunPod Secure Cloud, and every month USDC would flow into the wallet that was holding that NFT. What we're launching now is this pool token, which has a much lower like entry level. It's not a $5,000 entry level. It's like you can get in with as little as $1 or $100, and you would get exposure to a fleet of a diversified basket of different NVIDIA servers. And so I'll do a quick run through. Can you see this? I put this together right before the call, so this is not the world's greatest flowchart. But the general idea here is, so for this pool token, DeFi users come in and they pre-deposit USDC. And right now we have about, I think just over $300,000 in the pre-deposit. You'll see a lower number listed on the site. That's how much is in the contract at the moment. We have like some dollars in a bank account that have also been committed to this pre-deposit. And we're in the process of actually trying to buy the first 2 servers. But yeah, basically the way it works is, so users come in, they pre-deposit USDC, and then that USDC, the total amount for this pre-deposit campaign is, we're capping it at 2 million. And this will be used to bootstrap the first fleet of the pool token servers. We're looking to buy about 10 to 20 servers. And so what'll happen is like money goes from DeFi user 1, goes to our pre-deposit contract. Then periodically this is swept to buy NVIDIA servers that are in this data center earning revenues. And those servers, what will happen is once we buy the first batch, we will start distributing pool tokens. And what the pool tokens are is, you look at this pool contract over here, these pool tokens represent a fractional claim on all the assets in the pool contract. And the assets, there's 2 types. There's NFTs. These NFTs represent a legal claim on one of these servers in the data center we work with. And then there's also the USDC that mostly will come from the revenue earned by these servers. That also sits in the pool contract. And so anyone that gets a pool token at the start for this pre-deposit campaign, it's like 1 USDC will equal 1 pool token. And after we distribute these, so like let's say you bought 1,000 pool tokens and these are distributed and we have the first fleet of servers up and running. As those servers start generating revenue, USDC comes into the pool contract. And then what you can do as a user is, you can either burn the pool, if you want to realize gains, you can burn the pool token out of the pool contract for USDC at the NAV per token price. And the NAV per token price is basically just the initial value of the server minus the depreciation. We use a straight line depreciation, so it's the same amount as monthly deducted from the net asset value of the total pool contract. And then you add in the USDC that's in the pool contract. And so what will happen is, after like a month, as revenue flows in, the token that was originally worth $1 will now be worth $1 and like 2 cents. And if you want to realize gains, like, okay, great, I'm up 2%, that's 2% yield, I want to get out, you can burn it in the pool contract to get USDC out. Or you could go and swap it on an AMM like Uniswap at whatever the spot price happens to be, which should track. There's an arbitrage opportunity, so we expect the Uniswap the AMM price will track alongside the pool contract itself. And then, yeah, of course, on the flip side, this is like the cloud marketplace and the AI compute consumer who is paying dollars. Those dollars go to the cloud marketplace, and the cloud marketplace, their cut ends up showing up. The cut that the servers receive shows up as USDC into the pool contract. So yeah, that's like the. Am I still sharing my screen? I think I stopped.
Yeah, you stopped.
Okay. But yeah, that's the like detailed overview. I guess the really like simple like 10-second version is like, this pool token is like if you're bullish on AI compute and AI compute demand going up, basically you can buy this pool token and the price of it will go up in a manner that's like commensurate with the AI compute marketplace, and then you can sell that token at any given point in time once you want to realize yield. So this is a token that's not going to 2x. It's a token that like our projections. This is not financial guarantees of any sorts, but based on the existing fleet we've been working with, if you go to clusterzero.silicon.net, you can check out the existing fleet we have and the performance. That fleet's it's annualizing about 19%, as I said at the start of the call. And so we're projecting, like, depending on different scenarios, we're hoping for somewhere between 10 to 30% annual returns for this pool token. If based on a couple of different scenarios we've modeled out. Of course, there's like not zero risk here. If some crazy model comes out overnight and all of a sudden people can run inference on their iPhones, no one needs big NVIDIA servers, then like that could impact the market. Or similarly, if just people like, I don't know, there's some huge recession, like companies are spending less money on inference, then that could impact the market, like the returns of this. But yeah, that's sort of the high level of how this works. This is really just a token that is designed to generate cash flows from AI compute demand, and the token goes up in price as time goes on.
Where do you sit in the like counterparty stack? So what is the legal enforceability of these claims? I think when dealing with RWAs, it is very difficult to throw all of them in the same basket because there is a huge difference if
Yeah,
you're, tokenizing US treasuries where there is like they would be the last one to default, and I mean that is a very established market versus like trying to be the picks and shovel sellers for the rise of AI and super intelligence. So what does the legal enforceability look like? What is the vetting process of these data centers? Where are they located? Is it restricted to US only, or how are you set up there?
yeah. So this, we could just come up a lot. I think this is sort of the crux of any RWA project, is explaining the legal wrapper that can give people the on-chain guarantees they're looking for. And so here's how we're set up. So one of the like founders who's now like a founding advisor is this guy named John Michael Hands, and he is the CEO of a company called Farm GPU. And Farm GPU operates a data center in Rancho Cordova, California. And that data center pretty much exclusively runs servers on RunPod Secure Cloud, which is the premium offering by RunPod. You can charge a higher rate on RunPod Secure Cloud. You have to have uptime guarantees. It's something that only a professionally managed data center could get access to. And so that's the partner we work with. All the servers live at this Rancho Cordova data center. And the legal setup we have is that each of these NFTs is legally owned by, each of these servers is legally owned by the NFT that's tokenized it. And so what that means is you could actually, there's a process within the pool token itself where you can initiate an auction on specific NFTs in the pool. Like if you wanted to buy out one of the servers, if you have $200,000 and you actually want to pull one of these servers out of the pool, you could go in, go through this auction process, bid on the NFT. It's like a reverse Dutch auction. And if you own that NFT, you could actually then go, per the contract, the terms of service with the NFT, you could go to the data center in Rancho Cordova and be like, I own the NFT. I actually want to pull it out and like physically sell this server or move it and operate it. Or I just want to hold on to the NFT, and all the cash flow that server generates now just goes to my wallet outright, which owns this one NFT. So yeah, that's like the legal setup we have, is that these servers are owned by the NFT, and the owner of the NFT therefore owns the server. Other things worth mentioning. So we like some things people would need to consider like with an RDB. So one of the risks you have with servers is things like if something breaks, how does that work, right? Like these servers notoriously have like things go wrong. Like at some point throughout the year, there's going to be some downtime and some money has to be spent to fix something. And so our solution for this is that, so we have a service agreement with Farm GPU that covers a lot of basic maintenance. If something goes down on the software side, they'll go in and fix it. And then if like a physical part breaks, we exclusively only buy, and the pool token only seeks to hold servers that still are under warranty. So that we don't have this weird situation where like there's a server that went down, it needs a $15,000 part to replace something, and like who pays for that? So we exclusively hold servers that are under warranty, and when the warranty expires, we actually seek to liquidate the server out of the pool. This is how this entity is set up, and so once the server is liquidated, it's basically sold for cash, and cash is swapped to USDC, and that USDC just goes into the pool. That's how that works. So yeah, this is sort of like the legal wrapper we have. You know, he or she who owns the NFT owns the server, and we have service agreements in place to cover all the physical things that need to happen to maintain and keep these servers up and running. And of course, this comes out of the revenue every month. Like, you know, a portion of that revenue goes to Farm GPU as their margin, but also to offset their costs they have of like making sure these servers have good uptime, fixing things when they go down, paying for the electricity, paying for the space, the rack space that they're renting in this data center, all that stuff.
So, just to understand it correctly, what would influence and drive the final yield derived from these servers? Intuitively, it's only utilization and cost of energy, right? Like these are the only two fluctuating variables in that entire game. Or am I overlooking something?
There's a few. So if anyone wants to play around with this, we've like Steven from DeFi Dojo would be proud. We've built this calculator. It's at calculator.silicon.net. This has every single. Yeah, I can take you through the advanced view. You can see my screen, yeah?
Yes, sir.
Okay, so I'm going to click on advanced so that we can see everything going on. Well, let's do this for a single server, and let's do it for an H100. So H100s right now, you can buy these for, like on a used one for about $160,000 that has something like 24 months of service life left. So again, we seek to liquidate when things are no longer under warranty. So the first big thing you play around with this in this model, and by the way, you can see like this estimated APR here. This floating guy is the key number to look out. This is like what the annual return would be, not the total return after the life cycle, just like on a yearly basis, like how much would the value of this thing appreciate by. And so the first biggest hurdle you have to clear is liquidation residual. This is like what you sell the server for at the end of its life cycle. There's been a lot of discussion about this. Like Michael Burry famously was like weighing in on the depreciation schedule for AI servers. The general, like, I'm not an expert in the space, but the general industry consensus has been like the server life has kind of increased over time as we've seen older servers can still be quite financially productive just doing inference at the end of their life cycle. So generally, when a new server comes out right now, the latest generation that's in production are the NVIDIA Blackwell servers. These are going to be replaced later this year by the next generation. And these Blackwell servers, they're mostly used to do large-scale training runs. And these are the hyperscalers. They're willing to buy these things. They don't care really about economics of them. They're like, we need the best servers to do large-scale training runs. As those Blackwell servers age, they're going to kind of like move down the value stack and be used more and more for inference. And so this sort of dictates like how you depreciate the servers. The general number we go with is that the conservative estimate we have is that like a new server is worth it probably about 35% of its MSRP price 3 years after you buy it. So you straight line depreciate down to 35% over 3 years. Of course, there's a lot of noise in this market, and so that's like not perfect, but that's like the best guess estimate. This is one of the big plug numbers in this calculator that can really like drive prices up or down. So just calling that out. So in this situation, it's a single server. We're calling it an H100. This is last generation, NVIDIA's last generation of servers. We're seeing these on the used market go for about 160,000 that still have around 2 years of warranty left. The next number you play around with is the starting GPU hourly rate and the decay rate. So these go for much more than $1.84. Let me check the pricing right now. I think it's like $269 for an H100 server. Yeah, $269. That's correct. So you can already see as I've changed this number, the estimated APR is now at 25%. The hourly starting rate. So for us, this is pretty simple. We just look at RunPod, Secure Cloud, whatever their price right now is for that GPU. That's what we put. And RunPod isn't like Airbnb or some other platform where people are like all competing on price. Like RunPod pretty much lets all the servers of a certain class clear at the same price for hourly rental rate. However, what does happen is that price goes down over time, and it's not every single month that it goes down. It's sort of like every so often, every quarter, every 2 quarters, every 3 quarters, they will announce a price drop on a certain class of servers. And so you have to factor that in. And so what we have here in the calculator right now is we're factoring in that on an annual rate, this price, this $269 hourly rental rate goes down by about 15% per year. And this is what's spitting out the 25% number. This is pretty consistent with what we've seen actual decay rates be. So we consider this to be like a middle of the road estimate. It's not a conservative estimate. It's also not an aggressive estimate. Like, okay, what if it barely declines at all over the next 2 years? Then you can see the APR jumps up to almost 30%.
Are there any realistic scenarios where the APR would be negative? And if so, are you able to protect against this, or is there the potential of like your principal being exposed to negative flows as well? I mean, if you, for example, talk about Ethena, a tokenized basis trade, they can just withdraw from the trade and put the money into US Treasuries instead. Like the risk of negative yields is very straightforward to manage. Whereas here, you're actually like your capital is bound up in assets, right?
Yeah. So the real monthly expense that you have is in the, let me see if I can pull this up, the depreciation schedule. So you can see that like for this server, like every month, this is an accounting expense. It's not a real expense, right? But it does reflect generally the fact that if you want to resell this asset, you're not going to be able to resell it for as much as you bought it for at about this rate per month. So that's like one of the bigger like baked in expenses per month. The other one is that the like kind of electricity costs. So this actually needs to go up. It's around the OpEx for these servers, that brought us down to 22.5%, by the way. The OpEx, so this means like electricity costs, like the average maintenance cost, the cost of the employee that like is overseeing this thing in the data center. For an H100 server that for WeWork, that's about $1,000 a month. And so that's another like baked fixed costs. Of course, I think in reality, this could be lower if like no one was using the server, then it's not taking up any electricity. Maybe you'd cut this number in half, but still you would for sure be negative. But to show you like a realistic scenario for how you could get negative, it would be like, let's say the pricing, like it's really not, price decay is most unlikely. I would say it's utilization, especially on a single server. This is one of the reasons the pool token covers a fleet of servers. Let's say this server breaks. There's some catastrophic failure and like it's down for, I don't know, a large percentage of the year. And so if you take the utilization down to like 70%, you can see, okay, the APR just cut in half. What if it's offline for 6 months? Okay, now the APR is down to 2.4%. And you can see this line here is the break-even point on the calculator. And kind of like once you get around 45% utilization, you're underwater. So that's one area where things can go bad is utilization. The other is, of course, like the price. If something crazy happens with the price of these things, if it cuts in half overnight to $1, you'd be underwater. At $2, that's a 70-cent drop. Like I don't know what that is. It's like a 25 or 30% cut in the rate. You're still looking like a decent return. And this is even factoring that it's going to drop further from $2. But yeah, so the real like risk vector is utilization. These other fees are only off of the like if revenue is coming in the door. So this is the fee that RunPod charges. This is the like revenue that the data center makes. This is Silicon's fee. This is OpEx that the data center charges to cover their like fixed cost. And of course, the taxes are also taken out of this, by the way. Federal and California taxes are factored into this
the
APR.
OpEx also includes energy costs, right?
Correct. So yeah, if anyone wants to play around with this calculator admittedly is like pretty complicated. I didn't even cover the like disk rental. There's an additional revenue source that comes from like the storage costs. Like if you need to use the server, but also you have this like massive model you need to like hold in the system, like you pay for that as well. That's just like an additional bit of revenue that you could play around with. But yeah, I'm gonna stop sharing my screen.
What is your mid to long-term outlook when it comes to incentive design? Do you think that you have basically found a model right now that works in terms of incentives? There's no need for points programs, speculation, token incentives, etc., and you can just theoretically scale that up infinitely? Or do you think that as it grows and as we progress in time, and also the AI economy takes a few steps further, there have to be changes in incentives and the mechanics will significantly change?
Yeah, good question. So quick answer is no. I think this thing stands up on its own long term. If incentives are required, it's not going to make it. Like we have enough data from the past 2 cycles in DeFi to know that that is the case. So like for Silicon, so we actually do have a points program running. I'm actually not like out of the positives we've gotten so far, I'm not sure anyone is like really there to speculate on points, like what they will be for, what they'll be worth. I think people are showing up to like take a bet on this 10 to 29% estimated APR number. And so like our like thesis for growth and scaling is basically get this thing out the door, and start showing real like asset appreciation, show the NAV increasing on a month by month basis on chain for people to see, and like use that as the selling point to get more capital, more internet capital markets to come and form in our pool token over time. And really it's the yield itself is what people will be chasing, not points or any other like incentive that could pop up. It's truly just the fact that this is a very novel yield opportunity. Even off chain, I don't think retail has access to this kind of yield opportunity. And certainly on chain, there's not a lot of RWA projects that are attempting to like tokenize this sort of like more interesting like cash flowing assets like NVIDIA servers. And so yeah, general thesis is that long term, we expect this compute market to uphold. Now, I don't know how much this scales to. Like, does this scale into the billions of TVL? That I'm not sure. Like, as I mentioned, the main demand side partner we're working with right now, they're doing $120 million a year of like top line demand for compute. So that kind of caps out to some extent.
Well, I mean, for example, if you look at USD AI, I think on Pendle alone, they have almost 500 million in TVL. I mean, of course, I would assume that quite a bit of that is looped up capital, but then if you look at the deployment of that capital and the reserves, still the vast majority is sitting, I think, either in T-bills or in PayPal USD. and only a
Yeah.
fraction right now is deployed into data centers. I mean, respectively, they have very significant deals in the pipeline. I just checked their website while we were talking. But as of right now, like, the demand for the yield that people hope for, and also the demand for the points, does not yet is not yet
So
consumed by the actual demand for the data centers.
yeah. So I mean, one way to look at this is like, so silicon, we think, and of course, if you strip out some of the, like, if you're more vertically integrated, the yield could look higher. But like, we're projecting between like 10 to 29% yield, and USDI is like they were just wanting to charge like a 15% borrow rate to buy more servers, and so you can just think of like the cost to service that debt is quite high. And so I don't know exactly like which companies are looking at, like what their business models are, but one of the reasons I suspect they've been slow to deploy capital beyond the like sub 1% that's been deployed in loans already. They've announced all these big um like debt facilities that have like big flashy numbers, and none of it's been deployed. So I don't know if this is because like the economics right now aren't making sense for some of these players to like borrow at the rates that USDI is charging, or if there's some other reason, like there's supply chain constraints or something else going on that's preventing that. But this is definitely something I've been like following as well, and I thought is like kind of curious that AI capex is in such a boom. Why haven't they deployed more capital yet? Like, there's no like like demand has only like soared upwards in the past few months. So like, I'm not sure what the friction's been. Um, and again, I'm not saying there's anything nefarious going on here, like, but I've just been kind of like very curious about that as well. Because like, if you look at the project, they seem to be spending a ton of time on like gamification of this points campaign. They're very focused on their TGE, and I'm like, how much time do they have to actually go out and like do deal making and get borrowers in the door, um, for this giant pile of money that they've done a great job of accumulating.
So maybe one last segment before we are zooming out into the broader AI narrative, because I'd be curious to get your take on where we are in that alleged exponential curve. Can you share a few more details on the pre-deposit campaign? The economics behind it, where it is capped, how long it will last, if there are seasons, points programs, etc. So if people are interested in getting exposure, what are the different ways to get exposure as of now?
Yeah, so this pre-deposit campaign, like I mentioned, this is to go out and set up the first pool token. We're aiming to buy 10 to 20 servers. If you're really into the GPU space, we're looking at H100s, H200s, and NVIDIA Pro 6000 Blackwells. These are kind of like the three servers that we think the return profile looks pretty good on right now. And yeah, to get involved, you can just go to predeposit.silicon.net. You can punt one USDC into the pre-deposit and keep an eye on us, or you can put 100,000 in. Like, very flexible. We have a points campaign going on as well. So the first $1 million of deposits get 5x points. The second million of the 2 million cap get 3x the number of points. And yeah, this program should last for another like month to 2 months. But as money comes in, we do periodically sweep it out of the pre-deposit to go out and buy servers, to get them up and operational and generating revenues for when we turn the pool token on. Yeah, our goal would be like the day one, once the pool token goes live, there will already be servers operational at our data center with revenues already having arrived or on the way. And yeah, predeposit.silicon.net is the best way to directly get involved. We're taking USDC on all the major EVM chains.
Very nice. So over the past couple of days, we have seen quite a few AI exponential evolution, etc. articles going pretty viral.
Yeah.
One of them by Andrew Kang. There is also a series of essays by Duji De Luca, where he takes a much more refined stance on the internet capital market thesis that has been around for a few months now, where he essentially argues, if I understand him correctly, that crypto becomes the logical conclusion of financial rails, not necessarily because we have the better incentives or because like tokens are so great, but essentially it is the only technology where we can let capital move at the speed of software. So there is a very clear demand in his view for an internet native and like digitally native mechanism to move capital around. Because if we think AI forward, the price of software going to zero, maybe even the price of data going to zero in decades. Well, the only thing that is required to fuel things, to grow things, is capital. So capital is the thing that is lagging behind in terms of speed of deployment. So how do you think that choosing to tokenize GPUs is fitting into that broader narrative? And maybe as somebody who's now building in the picks and shovel space of AI, how do you personally view that exponential curve, and where do you think we are actually sitting on that curve?
Yeah, there's a lot you could poke at from this essay, or a lot to get inspired by. I think maybe one thing I would mention about internet capital markets that hits home for Silicon is that this yield opportunity is for sure interesting. The thing I'll confess, like the potential downside is like we don't know if it scales to billions of dollars of TVL. We're pretty confident it scales to tens of millions and even like hundreds of millions. And so with that being said, you could call this like a niche market where the like ease of and the speed of forming capital to put like productize this yield opportunity is very suited for crypto. And of course, we will move on to other like RWA tokenization opportunities if we see that like the carrying capacity for servers taps out at some arbitrary dollar amount. So that's one thing that I find interesting, is like crypto is uniquely suited to launch things where the like legal paperwork and the real world structures required to do it might not make sense if it can't scale to like billions of dollars. So that's one thought I have. And then in terms of this like curve, so I read that article too, and I was kind of like, it's pretty. It reminds me of like the Suju's like super cycle thesis from the like last
Well, I
cycle in
mean, to
crypto.
be frank, there is very little hope to cling to in this industry right now. So I think
Yeah,
the 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 idea of us serving as the inevitable financial rails to the entire AI economy, which right now is kind of the most hyped up
could be
sector
cope.
in all of tech and all of finance, well, that is at least something to hold on to. So I do think that there's
Could be cope. Yeah,
not many other places where else we could go right now.
totally. Yeah, I mean, I like personally, I mean, kind of a sidebar. I found the current state of like crypto, particularly if you were building crypto infrastructure, like it's so insane how night and day the vibes are and the outlook is on that compared to where it was 2 years ago when Celestia and all these like giant chains that were about to launch, like Monad, were like the darlings of the industry and the podcast circuit and investor attention and fervor and speculation. And now everyone's like, you can go buy Eigen for like 300 million FTV. Like, that's like maybe one of the biggest crypto infrastructure projects that ever launched is now at some like insanely low valuation. So for all that stuff to like have value, we have to like hope and pray that there is some new burst in capital formation that AI drives that like ends up running through all these like blockchain rails we've built. I personally am like, I don't know. I don't subscribe to that thesis directly, but I'm not against it. I'm kind of like a neutral. I'm cynical. I'm cynical of anything that comes out of like a hand wavy crypto article that goes viral on X. But I'm also like, I don't know. I mean, we have pretty good rails now. Like they could be used for something. It's not inconceivable to think that this new AI boom could end up shoveling a bunch of volume that we never even like thought could exist through crypto rails. But yeah, I don't know. What do you think?
I agree with the general thesis. I'm very unopinionated about the timeline of it, just because depending on who you talk to, from a security perspective, we are already in a very high risk territory. From a perspective of AI actually replacing workflows that are at the core of human interaction and like actually produce something in the economy, so beyond entry level white collar jobs, I think we are still quite far away. um, I do think that, less related to Andrew Kang's thesis and more related to Duji's thesis, the idea that crypto is, or blockchain as a technology is the logical conclusion for agentic payments, agentic commerce, and funding the expansion of GPUs, of compute, maybe even of energy, I very much subscribe to that thesis. I think this is more suitable for crypto than the mere trading and more efficient trading aspect, because at least in the past, I mean, I know that through Mega ETH and, you know, uh, Tempo and all of these newer chains, we are solving the scalability limitation more and more. Obviously, these are not as decentralized as Ethereum main layer or as Bitcoin, but many of them are also not dependent on like a super obvious single point of failure. So we are slowly solving that, but still, a blockchain is by nature a rather expensive and a rather slow way to store data compared to a centralized database. So if we have an established mechanism to enforce property rights and to store property rights, then it is much easier to delegate some responsibility to a centralized entity to trade these property rights of assets in between. However, if we think AI to its logical conclusion, a lot of geographical frictions that we have right now should reduce. There is going to be more globalization in terms of cross-national asset ownership. Um, like, compute in of itself is not necessarily geographically bound unless we explicitly make it so through legal frameworks like GDPR or whatever. So if we assume that to be the next step of, yeah, globalism in that sense, it does make sense to have a politically neutral and a hard to corrupt database where we can store the information about these property rights. So I think for that use case at large, blockchain is much more suitable from an intuitive perspective than just for trading these assets more effectively. So yeah, I would say that given the state of the market right now, um, and all the iterations of hype cycles that we've been running through that have rather failed, or at least failed in their experimental stage. When you think about meme coins, when you think about social tokens, I do think it is worth taking a shot at this narrative, at this sector, at this idea. I mean, AI is kind of inevitable. There is a huge incentive from every large actor to dominate it as a technology. There is no incentive from a nation state or from any large AI company to like restrain themselves, to restrict themselves. If there is an arms race in AI, there logically follows a large demand for capital because somehow you have to finance all of that compute. From that follows that there is a large demand for energy. I mean, if you really think this thing out for 10 years, 20 years, you could even come up with a thesis. We just touched upon that in the podcast I just had with Vlad from Tau Labs and Danny, that there is the possibility that in the age of AI, it doesn't even make sense to have the US dollar or even Bitcoin as the underlying unit of account and underlying currency anymore. it might even make more sense, or it might be more natural to most of the transactions that are being conducted, that a unit of compute or like a unit of energy defaults to being the unit of account and basically the currency we transact in. I think there are various outcomes there. Of course, if we kind of fall into a Matrix-esque future and we basically try to replace our physical lives with a digital one, this thesis makes much more sense, because then the things that are transacted that truly matter are conducted in the digital realm. However, if there is, and I personally prefer that outcome much more, if we are able to just automate away all the digital aspects of our lives right now, in terms of white collar work, spreadsheet work, etc., investing, and we can finally behave like humans again, like we are supposed to behave, and like do like real world stuff, then I don't think it would make a lot of sense to transact in a unit of compute as the currency, because all the things that now truly matter are real world things again. So I think in that case, it makes much more sense to have Bitcoin, or to have gold, or to have like something that is inherently scarce. Because I mean, thinking beyond a few years, the only two scarce things are going to be land in terms of real estate and in terms of farmland, unless we make unexpected progress in space colonialism, which I don't think is going to happen until like the end of a decade. And the other thing that is going to remain scarce is Bitcoin, because that is something that you can make scarce just through mathematics. And the base input into most economic activity is going to be energy. So you basically try to generate cash flow through energy that is deployed to fuel like all these economic work streams. You take that money you make from like deploying energy, and you use it to buy land, to buy farmland, to buy real estate, and to buy Bitcoin. I mean, it's a very, very oversimplified version. It definitely kind of reduces all the other things that we care about on the more subjective human experience. But I think if you try to like hyper rationalize it down, that is a scenario I could envision.
Yeah, I mean, if I'm not even a very good armchair economist, but if you like think about, I guess, like the whole petrodollar concept, and you like fully like simplify, like let's just say the US dollar is really just backed by its liquidity in the oil markets globally, and the US's involvement in the oil markets, then I guess you could look at this AI boom like, okay, is oil going to be replaced in the near future? Like, will some other commodity like electricity, compute, like compute, which is sort of like electricity plus like time in a server, is it going to be replaced by something like that in the foreseeable future? I kind of don't think it will be. Like, I think we're still quite a ways away from oil not being this like super important commodity that drives all of global commerce. Like, we're still quite far away from that. Um, and it's also not unreasonable to think that like electricity could also is not as much of a finite resource as oil is. It currently is a very finite resource. This is a huge problem in scaling data centers. You have to go out and find gigawatts of power, and there's a whole like industry around allocating that in the United States. But you can imagine in the future, like there's nuclear, there's other like fusion, all kinds of other like frontier technologies that could unlock a lot more electricity than we have oil. So I don't know that if like that makes sense. And then Bitcoin is sort of like gold, right? And like we haven't had a gold standard in financial markets in a long time. So I'm kind of like my boring take on this is like I just sort of think stable US dollar denominated stable coins sort of continue to be the like key player. I just don't see something out competing that meaningfully at scale, especially since stablecoins are really early in the early innings of this, and I don't think anyone's talking about Bitcoin denominated stablecoins or stablecoins pegged to some other asset taking off. So that's my kind of boring boomer take. I don't think there's any major unit of transaction disruption that happens in the next like 10 to 20 years.
I think on a 5 to 10 year time horizon, I would 100% agree with you. Anything beyond that, if we really are at the tipping point of the exponential curve, I think it would just be naive to assume that we can foresee how the world is going to look like in 10 years.
Yeah, totally. I mean, maybe it is all
all
land,
of these events are very dependent
water.
upon each other. These are all like dependent probabilities. If the US completely dominates the AI game, of course the US dollar has a much higher chance of like sustaining the monetary hegemony that it currently has. If, however, there's like kind of equal competition between, let's say, the US, Europe, Russia, China, maybe India, maybe Nigeria, Brazil, whatnot, well, we might have to find a more politically neutral compromise in that case. But yeah, I think it's too early to foresee that outcome. So yeah, we're close to hitting the hour. Are there any other topics you'd like to touch on, both related to silicon.net, but also the larger GPU data center and AI economy that we haven't covered yet?
No, I think that Max, thanks for having me on. This is pretty comprehensive. I'm pretty talked out. I think we've covered everything from the philosophical to the nitty gritty of how our product works. So appreciate you for bringing me on today.
Yeah, thanks for coming on. Always good talking to you. And yeah, where can people find you? Where can people reach out and learn more about silicon.net?
Yeah, you can find us at silicon.net on Twitter, and then I'm at Rob McStodda, Rob McStodda. If you just search McDavid on Twitter, McDavid Silicon, I think I'll come up.
Perfect. I'll make sure to put all the links in the description. Thanks
Cool.
for coming on.
Thanks for having me.